Today, we'll be looking at some more REIT stocks again. Last time we took a look at the residential REITs. Today, we'll be looking at the healthcare REITs. These REITs focus primarily on retirement housing, senior housing, rental medical office buildings, clinics, and hospitals. With our aging population and increased life expectancy, we can expect more and more people to require healthcare and senior housing in the future. First, as a disclaimer, I just want to say I'm not a financial advisor, so please do your own due diligence before investing. We will be looking at 4 healthcare REITs today. Of course, if there is one that I missed that you would like me to take a look at, please let me know in the comment section below and I'll make sure to include it in a future update. There are similarities between these REITs, but there are differences as well. Chartwell focuses mainly on retirement and senior housing, with a small portion on long-term care. Sienna is very similar to Chartwell, but with about 50% being on long-term care, and long-term care is usually funded by the government and is very regulated. Extendicare was focused mainly on long-term care, but has recently started investing into senior housing as well. Northwest Healthcare is slightly different than the other 3, as they focus primarily on rental medical office buildings, clinics, and hospitals. When looking at some basic information, we can see that Chartwell trades at a premium compared to the rest, but it is the largest among them. But the main point I want to point out today is the massive amount of debt Northwest Healthcare has, at over $3 billion compared to the market cap of $1.3 billion. They have an amazing yield at around 7%, but their payout ratio is over 100% as well. And in the past, their payout ratio is usually hovering very close to 100%, and they are practically paying out all their cash flow they make. Okay, so when we take a look at their revenue, the first thing you'll notice is the massive drop in revenue from Extendicare, but that is because back in 2014, they sold off their US operations. So if we were to factor that out, the revenues from the US operations, their chart will look much better. After we factor out Extendicare's US operation, their revenue looks much nicer without the massive drop. Another thing you may notice is the drop in Chartwell's revenue back in 2015, and that was also due to the sale of their US operations as well, which again affected their revenue numbers. But if we were to factor that out, we can assume a trend upwards. When we take a look at their funds from operation, which is a very similar metric to the cash flow, we can see that Extendicare isn't doing as well as the others. They have stabilized in the recent 5 years after the sales of their US operations, but in the past, with their US operations, their funds from operations has moved around quite a bit. In Northwest, we also didn't see much growth in 2018 compared to 2017, but in 2019 so far, we are seeing some growth compared to 2018, which is nice. Chartwell and Extendicare has cut their dividends in the past. Chartwell's payout ratio was well above 100% in the past, which forced them to cut their dividends. But even after they cut their dividends, their payout ratio was still around 100%, so they were forced to cut it again and again. But now at their current levels, they shouldn't have any problem sustaining it at below 70%, and they have been slowly increasing their dividend payments as well over the years. Extendicare was in a similar situation to Chartwell. Once their payout ratio got too high, they cut their dividends, but in the past several years, they've been hovering at around an 80% level. And like I mentioned earlier, Northwest Healthcare has been hovering at around 100% of the payout ratio even in the past, so I don't see Northwest Healthcare and Extendicare increasing their dividend payments anytime soon. With Sienna, we don't see much of a dividend growth, but they have been growing their profits and profits per share, and we see a very similar trend with Chartwell as well, after they sold off their US operations. But overall, the point I wanted to state is that their payout ratio was in the 80 to 90% range, but since they haven't been really growing their dividends, but they have been growing their profits per share, and now their payout ratio has dropped to around the mid 60% range now, so this leaves them room to start growing their dividends at a similar rate as their profits per share growth in the future, and then we might see some better dividend growth from Chartwell and Sienna. When we look at their funds from operations profit margin, we can see that Extendicare's profit margin has always been very low. Chartwell and Sienna has been trending upwards in the past decade. Northwest has come down a bit but still has the highest profit margins. When we take a look at their stock performance, we can see that Chartwell and Sienna, in blue and green, has outperformed Northwest and Extendicare by far in red and purple. Extendicare isn't even positive and has a return of over negative 20%. Northwest has pretty much been flat the whole time. So far this year alone, Northwest, Sienna, and Extendicare has really performed very well at over 20% returns, with Extendicare close to 30%, but in the past, Northwest and Extendicare has really underperformed. So in my personal opinion, which one do I like? First off, I want to eliminate Northwest Healthcare, mainly because of their massive amount of debt and their very high payout ratio. With that kind of payout ratio, they really have to raise funds to grow their business, as there's literally nothing left for the company to reinvest back into itself. They will either have to increase their debt, which I don't like already because they already have a large amount of debt, or they will have to sell more shares and dilute everyone's stake, which I also don't like because they won't really be able to grow their profits per share. And if they can't grow their profits per share, we can forget about any dividend growth as well. In my personal opinion, Chartwell is the best of the breed because it is the largest and they are growing. They are also more focused into retirement and senior housing with only a small portion into long-term care. I'm not a big fan of long-term care as it is more regulated compared to no care and just assisted care. That is why I rank Chartwell above Sienna because Sienna has about 50% of revenue from long-term care and Chartwell is the larger of the two. Extendicare is more focused onto long-term care but has recently got into senior housing as well, but the majority of the revenue is from long-term care, so I would prefer Sienna over Extendicare, especially since Sienna and Extendicare are valued very similar to each other. And as always, if you enjoyed the video, please like and share the video. I really appreciate it because making these videos takes a lot of time to do the research on these companies, and it really helps out the channel, and hopefully we can reach more people and help them make better financial investments. And if you haven't subscribed yet, please make sure to smash the subscribe button, and thank you for watching. I'll see you in the next video.